Chapter 5, Balancing Down or Balancing Off, and the Trial Balance. So the key points in this chapter are: we balance off T accounts in order to provide an additional check that the balance of the account that we produced has been added correctly. Shareholder reserves are missing from the list of balances for the creation of the opening balance sheet question. The shareholder capital balance is the difference between the debits and the credits that you then create, such that the balance sheet then tallies. So, at the end of an accounting period, a point where reports were produced from the accounts, the T accounts in the general ledger are balanced down for the purposes of determining the amounts in each account. To do this, step 1, both sides of the T account are totaled. A carried down, sometimes called a carried forward balancing figure, is put into the side of the T account that totals the smallest number, so that when those two numbers are when the two sides are added together, both sides of the T account should add up to the same amount. Step 2, the figures of both sides are then recalculated, and it's a check to see whether there's any miscasting errors. Are both sides of this T account now equaling the same amount? If they are, then we're fine. If they're not, it means that we've done a miscasting error. Step 3, the carried down figure then becomes the brought down figure on the other side of the T account, and that is the balance on the account. So let's have a look at an example. Here, in the bank account, we have £30,000 debit, £10,000 credit, £20,000 is the difference, which is put in the carried down amount. That's step 1. We then re-add them both together to see that they're the same. They're both £30,000. Step 2. We then bring the carried down into the brought down. That is the balance of the account. And we do that for all of our accounts as we're going through, and then that gives us all our balances. Students sometimes find the concept of the carried down figure strange. Why have it at all when we could simply put the net figure as the total being brought down for the number of the next period? So if we could just do, instead of his, not bothering with this carried down figure in here and totaling them, just go, right, okay, there's 30,000 on one side, 10,000 on the other, balance it down there, 20,000. Why bother with this carried down figure? This carried down figure and these totals. In a digital or computerized accounting system, this is exactly what happens. The minuses and the credits, the minuses, the credits, are deducted from the pluses, the credits, to provide an overall balance, plus or minus, for the account. However, in a manual system that is prone to errors, then you'll have to add them up. You've got more chance of error in this one. So the whole reason of this carried down figure is simply to ensure that there's less errors in there. If errors did come into a manual system, then it means that there's a lot of work, because you'd have to recast the entire manual ledger in order to be able to find out where that error is. This gives you a check as you're going along to see whether, oh right, no, actually I made a mistake in that particular one. That's the only reason why it's in there. It's just a check to make sure that your addition is correct, a double check in there. The reason why you do that in an exam, because there's not many numbers in the exam, so it's not going to be that critical. The reason why you do it in an exam is that essentially this is what checking your work is. So you can do this kind of thing with the carried down figure, then recast it to make sure the totals are the same on both sides. Then you know definitely that is the right figure. If they're different, you know that you added up wrong. And so that's the only reason why you're using it in an exam. You won't really see this in real life, because you won't see manual accounts in real life. In a digital system, you don't see this at all. The trial balance. So when we've done, the total of all of the trial brought down balances in the general ledger is the trial balance. Because it's based on two-sided journal entries that will always, whose debits will always equal credits, the total of the debits and credits should always be equal. The balance sheet should be known as what is tallies. So the plus money should always equal the minus money. So we have an example of our balance sheet here. Here's all our debits, which we had in the T accounts before. Here's all of our credits, and the amounts are the same. So you should now be in a position where you're going to go from source documents to create a trial balance. Now, in terms of creating a trial balance, in an exam, you're going to be given a list of numbers, and you're going to create an opening trial balance. In the exam question, imagine the way in which you're going to go about this is you're going to imagine that you're starting from nothing. So you're starting from 0, and then you're going to create the journals, which will be the debits and credits from these amounts that would result in the balances set out in the question. What is the type of money? What is the type of item? Is it a money in item or a money out item? What is the direction that money would create, increasing or decreasing? And that will provide you whether it's a debit or a credit. Now, two things to be mindful of in this question. Be careful to check whether it is a money in item or a money out item from the description. For example, Cash in bank is typically a money in item. It's typically a positive amount of money there. No. However, if they call it bank overdraft, actually this is going to be money out item, and so it's going to be a credit. So you're going to go down the descriptions, and they will often say things like bank, just bank with nothing behind it is a debit, and bank with an overdraft behind it is a credit. Now, why do they do this? Well, the reason why they do this is to try and see whether there's any learners who are trying to pass with dead click. You go, well, it's bank is an asset, and therefore it's always debit, and they put a little overdraft in there to go, no, actually it's not, because there's a direction of travel within. This money is going out rather than coming in, and therefore it's a credit. And that's the issue actually with dead click, is that you start off with this opening position, and then yes, but in this particular instance it's that, and in particular instance it's that, and the theory breaks down. That's why I don't bother to teach it. I keep it out of the thing. But you'll see that dead click or pearls. People will give you lots of advice to use that, but it will cause you problems within this position. You may not be given the shareholders' funds, the capital amount, and that again is to try and catch dead clickers, and in that situation what it's trying to sort of say is, will you understand the accounting equation and go through it and know that your total of your debits is equal to your total of your credits, assets equals liabilities plus share capital, and the capital amount is going to be made up of the differences between the debits and the credits that you've calculated in the rest of the question. So it's the balancing figure that brings it all together. Capital in real time is made up of the starting capital for the year plus all the movements in the year, both financial performance and receipts and payments to and from shareholders. So the financial performance will typically be your sales, your expenses, and other changes in capital will be missing. So that is the list between your difference between your debits and credits. It is possible that this figure could be debit. Yeah, so again, dead click when it's sort of saying, well, it's shareholder capital, therefore it must be a credit. And the company could have made enough loss, so therefore it could be a debit in there. It's more likely to be a credit.